Welcome one, welcome all to DeFi Crypto and Airdrops. I am Mike, aka Veteran Crypto, and with me for the Monday show is Taylor Willingham from the Willingham Law Firm, and then of course Jeff. Jeff has to show up fashionably late. Let me add Jeff really
Throw
quick.
him in.
Yeah, fucking Jeff,
Yeah.
that guy. All right.
You're gonna
Taylor,
throw him in.
why don't you kind of entertain our guests while I get Jeff added to the scene here?
Yeah, so I want to make sure people understand the environment that we're in. We are in the biggest bubble in the market that we've ever seen. So I want people to also understand that when you're in this type of environment is when the market goes up the most, but then it's also when you'll have the biggest crash. And the crash will happen suddenly and it will happen violently, and it's very hard to get out when you're in this type of environment. So don't get into this feeling of FOMO where I'm like, oh, I'm missing out. Like that's what causes the biggest loss is you'll jump in and then the next day it will be the black swan event will happen. And it's like, you have to
choose violence.
So if you're just starting off your investing journey, you take it slowly with money that you're like, okay, I'm okay. I can lose this money. Because we're in an environment that, it can keep, the queues can keep going up here. And, but just so everybody understands that's gotten our newsletter, we are bearish all major crypto. That means there's a bearish trend on everything. So if you're going into crypto right now, you have to understand there is more likely than not that this is going to continue to go down for a while before we go back up. But
speaking of, real quick, let's go ahead and let people know where to find us. So if you want to join the conversation in the chat, go ahead and head on over to YouTube to DeFi Crypto and Airdrops. You can join us live. You can ask questions. This is our panel that we have on Mondays. Taylor is an estate lawyer. He deals with wills, trusts, small business formation, tax mitigation, all kinds of things like that. Has his own law firm. So definitely speaking from a place of experience. A lot of people in crypto, they're always, I'm not a financial advisor. This isn't financial advice. Hence, Jeff, he can give financial advice legally. So
I can't. Well, this technically is not financial advice, but I am coming from a financial advising CFP lens.
Exactly.
And the reason it's not financial advice, folks, is I'm talking to the internet. I don't know your situation, so I can't give advice without knowing your situation.
And that's why he's licensed, is he knows the difference. All right. So again, that's where you can find us, and links to all of our affiliates and to our new website that we have launched, DeFi WIZE, WIZE with a Z. And that is where you can find our newsletter. We just launched it end of last week. We've sent out our second newsletter, and both Friday and today, we have nailed the bottom range of what we called on Bitcoin. So, Friday there was a bit of a dip. Today there was a bit of a dip, and both of them we called the range perfectly. So there's DeFi wisdom in there. We're giving out ranges if you're into trading. Also just kind of an overall market sentiment. So if you're just looking for something, if you don't have a lot of time to just pour over the internet and look for news, basically I do it all. I get up at 4 a.m, pour over everything. Taylor does the same thing. We boil it all down into a nice, neat newsletter that gives you a snapshot of what's going on in the market so you can go about your day. So
I sleep at 4 a.m.
Yeah.
I'm not it up at 4 a.m.
But I want you to understand that when you're in these ranges, like when you're bearish, that trend, that usually means that it's going to break through the bottom versus breaking through the top. And so while we have hit it 2 days in a row, if it continues to bounce off this bottom like it is, it's going to eventually blow through the range. Like that's just how it works. But we put it on there every day. Like we said, if you notice, it says trend bias is bearish. Every one today, every one of them is on the bearish. So Now, that being said, if you're DeFiing, the purpose of DeFiing is to generate this yield in order to reinvest it. And hopefully we don't have a total collapse hopefully there's not a black swan event that happens anytime soon, but that's investing they can happen. And we're hoping to keep going with it.
And this is one thing that I added today. Had some people in our Discord, asking for, kind of ranges that I would pick if I was going to enter into some of the, larger pools. So I'll probably start sprinkling these in. Basically just basic lines of support and resistance. If I was to enter a pool right now, this is kind of, where I would put my upper and lower limits, and then just a little bit of news. So again, it's just, we boil everything down into a nice, neat newsletter that you can, read with your morning coffee. It should only take you about 5-10 minutes. So, all right, let's jump on into here and let's go ahead and kick it off. So, what are you seeing in the markets, gentlemen?
So right now in the market, the reality of the situation is the market keeps going up unless there's going to be some big event that's going to cause it to go down. All right. So, but that being said, is those events happen just randomly and you just don't know. But looking forward for this quarter and next quarter, we're still in an environment that the market is going up. And so overall, everything is still in play. Gold just recently has broken trend. Gold it could very easily come back down right now. I mean, it did have a huge drive up, kind of an epic drive up. And usually crypto trades with any kind of, it's considered a commodity in its trading environment. So if gold's going down, then crypto traditionally goes down too. So just so people kind of understand those environments that we're in, Jeff sent us some interesting articles on X just recently.
Actually, Jeff, do you want to share the the thumbnail and the title of this episode is the what was it, the Stripper Recession Index.
Let's see.
So what is the Stripper Recession Index that you sent me this morning?
Well, I followed this guy on Twitter and he posted this. Let me see if I can find this real quick. That's pretty funny. It's this. So the idea. I mean, I don't really know how. I got it. You want me to share my screen here?
Yeah.
All right.
I'll pop us over to. Go ahead and share your screen, and I'll put it up and then transfer it over.
This is safe for work ish. Let's see. Share my screen. Share screen. There we go. All right, here we go. So I saw this morning. I thought it was pretty funny, but probably also it made me think of the movie The Big Short. I remember that scene in the movie The Big Short where Steve Carell's playing Michael Burry's character, I believe, or maybe no, he's not playing Michael Burry's, but he's playing another guy that's wants to short everything, and they go to a strip club for whatever reason. They're not actually going to a strip club for the normal reason. They're like, there's a reason they're going there, and during the dancing, the stripper is expressing about how she just closed on her 5th house for rental purposes, whatever. It's like 2006, right? And he like, that's all he needs to hear. He gets up, he runs out of the club, and he's like, sell it all. Exotic dancers taking out 5 mortgages because, real estate's never going to crash again. That's a sign. Similarly speaking, you have this. So if I scroll, you guys can see this, right? So here's the link. It says a quote from the thing is, prior to COVID, you could expect a ratio of 5 to 6 customers per girl. Since COVID, it's dropped to 1-on-1 or worse. And so when you click on this, I mean, it's a BuzzFeed article, so who knows, but the idea is that the discretionary income is gone, right? You're spending it all on the crazy inflation of food and of rental costs and healthcare costs. And folks do not have the money to go throw cash at ladies dancing. However you feel about that, good, bad, or indifferent, it probably is a pretty damn good sentiment indicator, right? Because you have that. I mean, it's across political lines, it's across demographic lines, it's across rural and urban. I would be interested if someone would ask, the girls at Score that make $2,000 a night, if they've seen an impact, or if it's just the more standard average Joe place. But they're going through and they're literally talking about hey, we're not, like this NYC girl here. I know of multiple girls who've lost their apartments. It's the worst anyone has ever seen for the industry. I've heard a few guys at my work say it's too expensive now, even for a bachelor party. And some of these guys, all caps, really like going to strip clubs. Another one says it's a boom and bust business. When I first started, a girl walking out with 5 to 10K in a Friday night was expected. I've seen girls, dancers for absolute fits because they only made $5,000. And then now it's, not even close. So I thought it was an interesting commentary on our economy. And
but that's also a problem with this index is before, when the market was dependent upon the actual economy, that was true. Since COVID, everything has been broken, where the market has continued to go up while regular people have struggled. Now, and kind of to that point is the understanding that means that the market really is in a dangerous position, because traditionally we've looked at the economy to determine whether the stock market is going to continue to go up. Now we're in a kind of position. I think crypto actually is probably more tied to the actual economy than the market is now, because since COVID, the rich have just gotten richer, the poor have just gotten poorer.
And also another corollary to that, Taylor, is 83% of the market is owned by the top 10% of wealth holders or households. And so you have this issue where my wife is rewatching Downton Abbey, so I'll go in, see it on the TV, leave, go somewhere else, right?
Right. But, the wife is watching it.
The wife is. I've watched some Downton Abbey. I'm not going to lie. I've seen some Downton Abbey, but generally speaking, it's a little too slow. But
it's a good show.
That being said, what it made me think about, though, is the concept that I was right. What is the late 1800s into the 1900s? This noble family coming into modern times, and there's a quote my wife mentioned this morning that or last night that made me think about this, where the Maggie Smith's character, who's like the matriarch of the family, right? She's like this elegant 80-year-old lady, so she's probably born in 1820 in the show or something, right? And somebody is at dinner that's a more common person, and they mention the weekend. Do you have plans for the weekend? And she looks at him with this air of haughty mystery and disdain and goes, I'm sorry, what is a weekend? Right? Because she's noble, she's never worked. There is no weekend for her, right? It's always the weekend. So what that made me think about is, in that show, there wasn't going to be a time where they had to worry about selling off land or selling off property to make ends meet, like the servant class or even the craftsman class, like blacksmiths and whatever.
They're not going to have to liquidate assets in order to pay the bills.
Right. And so I think we're in the same scenario where we see this K economy where so much of the wealth is so concentrated so highly that, they're immune to what's going on in the real economy, at least currently. And so the market can keep rising because you just have wealthy outbidding wealthy, right?
Gotcha.
Relative term, wealthy. And then you have, of course, sort of the middle class and upper middle class bidding every 2 weeks with their automatic payroll entry into their 401ks and et cetera through their workplace things. So that's a constant bid in the market. Meanwhile, you have 90% of the people that I think I read 65% of Americans literally are paycheck to paycheck. They have less than $1,000 for an emergency.
No, if you look at the data, it's not good. I mean, credit card debt is at an all-time high. You have repos that are going through the roof. I mean, it's, the cost of everything is going up. I mean, groceries have doubled, tripled. Energy costs are, all skyrocketing, and people aren't making more money. I mean, they're not, it's not like people are getting raises through all this. You have people that are on food stamps. Everything I'm reading is, people aren't getting their SNAP benefits and things like that with the government being closed down. I mean, there's a lot of bearish indicators right now, like Taylor was saying earlier. So absolutely.
How do I update I got one more thing on this before we move on. How do I update my screen share again?
Hold on one sec. I'll bring it back.
So this is just
you gotta share it again.
All right, here we go. This is as of January of 2025, so it's actually higher. No, I want X. There we go. This is actually worse than what this is showing, right? So this is as of January. Can you see it? So this is a valuation. So valuation is always tricky because there's different ways you can measure how expensive or inexpensive the market is, right? But what I thought was interesting about this is averaging trailing PE, forward PE, PE's price to earnings ratio, how much are you paying for a stock versus how a dollar of earnings, right? So if a stock costs $10 and you get a dollar of earnings for every $10 stock you own, that's a PE of 10. If the same stock in 10 years cost $100 for a dollar of earnings, that's a PE of 100, right? So just so you know, companies like Oracle are like 400 PE. I mean, just crazy stuff. So if you look at this, 1929, 1966, 1999, and here we are right here. And you got 1, 2, 3, 4, 5, 6, 7 different methodologies of valuing the market. So if you think the market's going to keep going up, which it absolutely may, right? Because who the hell knows with this AI situation? It may. And it might for a while, but you have to believe it's truly unprecedentedly different forever for the eventual decline on the other side not to happen. And that is something I'm not willing to bet most of my clients' money's on, at least not without a hedge or someone with a plan.
Yeah.
Just want to put that out there, talking about because that was what basically Taylor led out with. And
so,
guys, it's a scary
really quick, Jeff, those that don't understand, and please correct me if I'm wrong, because this isn't my area of expertise, but basically by a hedge, you mean that like if you make a bet, like say a bullish bet, that something's going to go up, then basically you would hedge that with a smaller position, that would be bearish, that in case the market, goes against you. Would that be an accurate?
Right. There's a lot of different ways to hedge. So you can hedge by doing something like that, which is something called a long short fund.
I know I oversimplified it. I just want to make sure people understand what
basically the idea of being hedged is if something goes the wrong direction, you are positioned in such a way that you don't necessarily go down with the ship. You have your parachute, you have your escape craft, right? And so, for example, a lot of things that Taylor and I partner together, but my partner Kathy will do is like there's something called structured products, which is a way you can go through investment banks, and if the markets go up, you participate. If the markets go down, depending upon how much they go down, you don't lose anything or you lose significantly less. Like for example, I have something right now. It's a 2-year hold. It's liquid. It goes if the markets go up to 30% over the next 2 years, you get all that return. If the market goes up 50%, you only get 30. But if the market goes down, the first 30% it goes down from the point you buy in at, you don't lose. So if the market is down, so if we wake up, you invest, 2 years goes by, you come out of your Rip Van Winkle sleep and go, man, what did my account do? And the market's down 40%. In that example, you only lost 10. That's what I mean by something that's hedged, right? Because I would rather get 6, 7, 8, 9, 60, 70, 80, 90% of the upside and either skip the downside or significantly mitigate it than get all the up and all the down. Because technically speaking, if we look at history, you're buying at a really expensive time. Doesn't mean you can't make a lot more money, but I'm telling you right now, the people I know that have been doing this in the game the longest, I'm talking about people significantly more experienced than me. Their only question is, are we in January of 2000 or are we in June of 1998? Like how close to the top are we, right? And how much more money is there to be made? I actually had dinner, well, happy hour, with a gentleman that used to work for a company. He's been in investment banking his whole career, and he worked for a company called MunderNet.net, Munder Funds, and there was a special fund called MunderNet.net, which, if I remember correctly, was an internet VC fund, like an incubation startup internet company, right? Um, and it went up like 168% in like 1999. Only by the end of, and I'll have to look at these numbers at some point in time. Let's see the flag. So let's see if I can find this really quickly. But the basic math is like it made like a 250% return from like 1998 through 2000, only from that point to crash by like 93% over the next 3 years, right? So yeah, you want those phenomenal gains, but it kind of doesn't matter if you give it all away and then some.
Right.
I mean, I think I'm looking at it right now. I can't see the total growth, but the flagship fund lost 54% in 2000, another 48% in 2001, and another 45% in 2002. So between the investment losses and investors yanking their money out, the fund shrank $1 billion in 2001.
Well, let's shift gears a little bit. I mean, I definitely want to touch on some of this stuff later on, but I want to try to balance this out and maybe give a little bit of bullish sentiment, just to kind of balance things out. But I'm going to rattle through a couple of things that I found here on Twitter real quick, and then Taylor, I want to kick it over to you. So it looks like the Treasury just bought $2 billion of its own debt. I'm going to kick it over to you, Taylor, and let you tell me what you think of that here in a second. Just in $4 trillion, JP Morgan head of markets confirms banks that their bank will buy and trade Bitcoin. It's JP Morgan now accepts Bitcoin and Ethereum as collateral. So, if you want to get like a home loan or something like that, they're accepting Bitcoin and Ethereum as a down payment or collateral for loans. So, that's very bullish for crypto. And then I would be remiss if I didn't touch on the big news of today, which is Balancer, a DeFi protocol that's very well established. And scarily, a lot of different DeFi protocols use forks of it to access liquidity, got hacked. And over 100 million has been stolen so far. So this is the different chains that I was able to find, just that basically have, or accessing liquidity from Balancer. So Ethereum, it's showing, this is how much that, that's on each one. Barachain, I read that they paused, they're centralized. And so they were able to pause their chain to mitigate losses. That is one upside to a centralized chain, being able to pause transactions to keep people from losing. Arbitrum, Base, Sonic, Base is very small, only 3.9 million. Sonic, Optimism, and Polygon. So so far it looks like the total is 128 million as of this post. But Balancer today around 7:48 a.m. an exploit affected Balancer V2 compostable stable pools. Our team is working with leading security researchers to understand the issue and will share additional findings and a full post-mortem as soon as possible.
Yeah. So
and then one last thing, and I'll kick it over to you. So Beefy. This is one that I know, Taylor, you've used. I've used it before, and I got off of it. I didn't like the fees. But Beefy Balancer V2 products are paused. So, I mean, this shows you how a lot of these different protocols are interconnected and leverage each other for liquidity and pools and things like that. So, Taylor, what were you about to say? Sorry.
So, yeah, because the thing that really, one of the issues right now with crypto is the problem with this constant reinventing a new project, and every 6 to 9 months, everybody moving their money to this new project that is started. Whereas generally in the market, this stuff is prevented from happening, or this type of, constant moving back and forth to different things, because it's hard to get listed in the stock market. There is institutions stopping the constant moving of assets to new projects, to new ideas. A good example is like Plume. Plume was this great project that got started at the end of the year, and it's just hasn't gone anywhere. Not that they don't have a good idea, not that or Ondos are another good one. It's just the fact that the money is just moving from one project to the other. The one thing that's kind of been consistent over the last basically 4 years has been DeFi. DeFi has been something where people have put their money and gone, okay, I'm going to leave my money here because it's a great way to make yield and make money. And now we have one of these issues of, you have one of these major platforms get hacked. How is that going to affect DeFi, and how many people lost their money because of this? Because this pool was rated that had people's money in. What is Balancer going to do to fix this? Because if the hack happened, how long is it going to take to refund the people their money? Can they do that? Do they have the means to actually go in and figure all this out? Because if people lose faith in DeFi, that's going to really affect the whole kind of system that they've created. So while the idea of having everything decentralized is something that we all really want, and we're hopeful it works out, these institutions big institutions do play a good role in, protecting people's assets.
Mm-hmm.
And so with Balancer's issue, it is a big issue if people are, especially Michael, you're putting your money out there and you realize, hey, I can't access my funds on this platform now.
Mm-hmm.
You're going to be like, well, am I going to continue to keep doing this and keep putting my money here? Probably not, because you're not going to trust the system. And so it is a big problem. It is a problem with Balancer that needs to get fixed, that they need to come forward quickly as possible to show everybody, hey, we're going to fix this. We're going to get everything set up again. But also, it's the realization that all these platforms are building upon each other. So when one has a problem, it can go through and affect everything else.
Yeah.
And so
potentially, yeah.
And I don't understand, where, a lot of the institutions I'm using, what platform are they basing their stuff off of?
Yeah.
And so luckily none of my money was affected, over this morning, but it has gone, okay, maybe I need to know more about this institution. I'm going to put in this pool. Who are they using? What organizations, and do I trust those
Yeah,
organizations?
basically do your due diligence. I mean, it's it's one of the reasons I'm so bullish on trying to use platforms that are non-custodial. And a lot of the that's one of the reasons I really love Base too, is it really seems like, I mean, I need to do some more research now, but from what I've read before is, most of the major, base protocols like Aerodrome, like Morpho, they're not connected like that, to other, other chains and other liquidity. Most of their liquidity is on their actual platform. So yeah, they might not have, the big sexy number that Aave has, or, other, Uniswap and things like that. But they're also, not connected, to as many places, and have potential exploits that are, possible.
Yeah. And so all that is stuff that needs to be considered into this. But, I sometimes the universe gives you a gift, and for Balancer, I know it sucks to lose $100 million, but it could have been a lot worse. And now they can look into the system and to go, okay, what's going on? How do we make it actually work and actually function? So at the end of the day, it's the Wild West. You've said this before, Mike. I've heard on your show.
Yeah.
You can make a lot of money, and you can lose a lot of money, and you have to be prepared to understand that this This is all systems everything. Now, DeFi has gotten to a pretty good point. I know when it first came out, it was very, it was common people, the pools being hacked and
Exploited.
yeah. And so at the end of the day, looking at everything, I still think it's the future because I think this is where everything's going. But also, I think crypto is more subject to what's going on in people's real life. That's why you see things are kind of bearish right now. A lot of times, I think the stock market is in fairy tale land with valuations. And so while you might be scared of crypto, I also would say you probably should be hedging what you're investing in the market too, because
should we? So, I'm sorry, Taylor. Finish. I didn't.
No, go ahead, Jeff. I'm done.
Well, two things. So, to our hosts, quit being a doomer. Give us something to balance it out. I will say, I did find there's something called a Dodge, not Doge, a Dodge Momentum Index, which is the Dodge Momentum Index surged 60% year over year in September, the highest on record. This index serves as a leading indicator of non-residential construction, tracking projects that typically move from planning to groundbreaking within 9 to 12 months. The jump was led by 75% year over year spike in institutional projects such as healthcare and public buildings, and 53% jump in commercial activity driven by data centers and retail. So looking at that massive spike there, you want to know where all the money is going that's going into oh, sorry, did I screw that up? I didn't mean to.
Yeah.
All the money that is going into, here, I'll do it again. There we go. AI is showing up in construction. So I'm not quite sure how to play that, but I do think that's an evidence for the boom not being over yet, for sure. Again, doesn't mean that the sentiment might not change, but I did think that was a pretty, I mean, you look at this, that's a hell of a spike, right? So I thought that was an interesting point to where sort of the money that's going into these, these crazy valuations is being translated back in the real world as they're trying to build compute and all this. Something else that I'm interested in is I'm reading a lot of articles over the weekend about recursive AI and some of these other ideas where they can take a much smaller data footprint as far as chips are concerned and still get the same output, which if at some point in time, someone's going to have a tech breakthrough, that's not going to be NVIDIA, and that's going to be really interesting.
Well,
right?
It actually might have already happened, Jeff. A Chinese company claims to have invented a new way of computing. I was watching this. I forgot their names. You know Chamath.
Yeah. Papatati or whatever off of All In Podcast.
Yeah, All In Podcast. Yeah. So him and Dave Sachs and those guys were talking about this new technology that was invented, and basically what the problem is with like our computing, and it has to do a lot with the fact that all the companies want to basically control all the usage of everything. Is our CPUs, when we're using them and those graphic cards, it can't make a differentiation between what's going on. And so when you get on your computer, it's just all using the same chip. And so it's like the whole processing is bogged down because it can't sect out your different usage on different things. Now, I'm not a computer guy, so what I'm explaining is not the technical actual understanding. But this company in China figured out, well, their actual chips, while they don't have NVIDIA's abilities, can divide out and actually use separate parts of the chip towards different functions.
I think that's called parsing, if I'm not mistaken.
Yeah, it might be. I have no idea.
Well,
the key here is to understand is that the energy usage went down by 90%, and the computing power of their chips is like 100 times stronger.
Yeah, no, it was nuts. I saw that's like I've seen that. There's a sample. There's like 3 different things that have happened in the last 2 weeks, at least at a theoretical level. where much, 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 much less resources to do the same or better. Now, some of it, is it scalable? Is it not scalable? Whatever. But like on the China one, so, right, Trump just met with Z, right? Or Xi or whatever, right? And apparently, as part of the negotiation, he put NVIDIA chips back on the table because we haven't sold NVIDIA chips to China since 2022.
Yep.
And he's like, we're good. Said no. It wasn't a sweetener. He wasn't interested because you know what happens when you try to blackmail technology for a country that has literally like 8 times the number of PhDs in mathematics and physics, computer science.
They do what a smart person would do, and they make sure they build out to be less reliant on that.
And here's the thing, right? It's an argument. I mean, I know I don't want to get super down the political trail, but it's not like North Korea, right? That's isolated and they're crazy and whatever. The people in China that have the PhDs got them from our universities. We're teaching them how to do this shit. So it's not like they're not capable, right? So it's an interesting, I thought that was a really interesting aha moment where we're like, well, we do have the best in the world. They're like, yeah. So,
it's all right.
And like the key thing, one of the things they said that was fascinating, that these chips technically would be illegal in the United States to use because they don't care about the licensing rights for different things that are used. And so while they would be illegal here in the United
States, what's that?
So the fact of the matter is they're going to be, if that technology can't be used here, but it can be used in China, and China just says, screw your licensing, we don't care, to all you companies, we're just going to use this technology. Well, their AI is going to vastly outwhelm ours. Now, I found that also was. Did you ever show on any of your shows that the AI investing platform that was investing in crypto and how and the tracking that was being done?
I didn't show it. I mean, if you want to show it, go ahead. I mean, we did a deep dive on Friday on a new platform called Glider that's just launched on Base, that you can build out automations. And basically it's going to make it to where you can build out all your different strategies, your borrowing and lending, like looping, regular investing, if you're just doing, day trading, liquidity pools, all of it. And you can just build it out and it will just automatically do it all for you. And, and then of course there's Mamo, that, it's a very basic one, but
I have a confession for the DeFi crypto community.
What?
Taylor gently, lovingly took my DeFi cherry this weekend.
Oh, was it magical?
It was a lot of what the fuck is what? Yeah. So and some things really clicked, which was nice. Like I'm like, oh, DeFi is just market making for crypto. Okay.
Yeah.
I also realized that a lot of
that's why I call them AMMs, is they're automated market makers.
A lot of the crazy yield is based on the native token of the exchange or platform you're on, which is why you see sometimes that goes down as people go, right? Because they're as far as I can tell, they keep dropping more and more coin, which is diluting the holders.
Yes and no. So I don't want to go too far down the rabbit trail, but like Aerodrome, if you open a pool on or provide liquidity on Aerodrome and you stake it, then you earn Aero token. Yes, the native token of the platform. However, if you don't stake it, you earn the assets of the pool. So if it's a wrapped ETH Bitcoin pool, you'll earn Bitcoin and ETH. And so it
I
really
have no idea what I did. Did we stake? Did we not stake? What happened, Taylor?
No, we did not stake.
We did not stake.
And then Uniswap does nothing but pay you in the assets of the pool. So it really just depends on the platform. But yes, Jeff, that can happen.
I'm talking about some of those when you see like 300% returns. That's either because of massive activity, right, with tons of fees happening all the time.
Yes.
Or they're really sweetening the pot with their own stuff or combination thereof.
Yes. So you're correct
Thanks,
in
Meta.
that assumption. It's a couple of ways that it could out. Other times it's incentives. So say it's a new project and they donate tokens to the pool to incentivize people to provide liquidity for it. So that can boost your earnings.
And
There's a
that's where all
lot of
this airdrop stuff comes from, is if someone's trying to, right?
airdrops are potentially a whole other thing. It mostly that is from helping test the protocol. So uh, California Jeff, airdrop Jeff, he that's what he specializes in. So
Mm.
basically you use their protocol to swap, to bridge, to whatever it is that they do to stress test it. You're basically getting paid in their native token to help them test it out, and you might get nothing, or you might get $1,000 or more for helping them do it. It's just a crapshoot. So we won't get too far down that road. Did you want to share your screen, Taylor, and show them that AI deal? Or
I'm trying to find. I forgot what the site was that's doing it.
Ellie says, "Naughty, you lost your cherry."
It was
And then
wonderful.
Betta says, "Congrats, Jeff."
Yeah.
So I got to ask. Well, Taylor's looking for that. What
Mhm.
platform did you guys use, and what did you do? A liquidity pool? Did you lend?
Liquidity.
Like, what did you
Hey,
do?
so let me see if I can answer this while completely screwing up, Taylor. You can tell me. So we're using Uniswap
Okay.
on VFAT,
Okay.
and we're doing a liquidity pool, which is USDC versus Coinbase BTC.
Okay. So a USDC Coinbase wrapped Bitcoin pool.
Yeah.
With
Perfect.
point, and the pool fee is 0.05%.
All right. So yeah, the pool fee, the higher that number, the potentially the more fees that you earn, because that's basically what they charge for a swap.
Right. It's
So
the surge.
so like 0.1, 0.3, something like that would be a lot better. But with Bitcoin, I
Mhm.
mean, 0.05 is actually, pretty good. Because you're gonna usually make that up in the volume of swapping that's being done. So you're not, people aren't getting hit as hard as far as the fee, but there's a lot more swapping going on. So it's kind of, six in one hand, half dozen in the other.
Mm-hmm. Wait, these
Yes.
aren't strippers.
Yeah, sorry, black guys, we're not strippers. And
Well,
trust me,
not
you don't
during
want to
the
see you don't
day.
want to see any of us strip. All right,
Yeah.
here he goes. Jeff will
Well, he
entertain
doesn't
us.
know that we're technically we might be. So
Hey, yeah, hey, you know what? The market's down. I need dry powder.
Yeah. Dude, I cannot. You remember what that site was called? I cannot remember what that site was called.
I just remembered that it was like 5 different AI platforms. So it was like Chat GPT, Grok, and a couple other ones that I'd never heard of. And basically they gave it all the same parameters. They gave each the same amount of money. And basically just let them auto trade. And it was basically 2 AIs that I had never heard of that were outperforming Chat GPT and Grok and all of them.
Yeah, it was DeepSeek and this other Chinese one. The Chinese ones were the ones making money. Everything else was losing money.
I got plenty of $1 bills. I'm
Black
sorry, sir. This is a crypto thing. So if you throw, Coinbase wrapped ETH to me, I'm not interested.
That's right. See, Jeff is starting to catch the fever. Yeah, he'll strip for Bitcoin, but he won't strip for that dirty fiat. He'll be a dirty boy for some Bitcoin though.
I also will do for ribeye. So that's if you want
Yeah.
Oh
to
yeah. Well,
actual.
you guys need to come back up here to the cabin, and we'll cook some more steaks.
It's a long way to go for a steak.
It
You gonna,
is.
you gonna throw
It's a
anything else in
destination.
there?
Yeah, yeah. We can work something out.
I keep finding articles about it, but none of them will link to the actual site that's doing it. Do.
Betta says go to your web history, but as much as you do on the internet, finding it in your web history would probably be next to impossible.
And I don't want people to see what I've been looking at. So, all right.
So food is life. XRP. We don't accept XRP here.
That is the hardest thing because every time I get on like TikTok or Instagram, that's all it is these people trying to push XRP. And I'm like, dude, they must pay a lot of money for all these people to be pushing it.
I have not found any evidence of it, but I've always suspected it just because of the amount of channels that do nothing but talk about XRP. Like that's it, literally. And they have huge followings. They obviously make a lot of money doing it. And I just refuse to do it because everything that I see about XRP and what Ripple is doing is basically taking away from the potential of XRP. And I'm not going to go down that rabbit trail. I do it enough, on our other episodes.
Yes, but an actual literal steak.
What's that?
Betta goes actual literal steak, Jeff. And I'm like, yeah, actual literal. Either one, actually. The steak I can eat or the steak I can't. I just want steak. Oh, man.
Oh, wait. Maybe let me Google this to see if that pulls up. It's amazing. All these articles, not one of them is actually linking to the site. They all just talk about it.
And Black Ice, you're right. What's that?
I finally found it. Let me share my screen.
All right.
There we go. All right. So it's Alpha Arena. That's what that's called. I can't believe I couldn't remember, but I mean, it was up big time. But even so basically this is it. You just kept your Bitcoin. All right. The only two that are up are the two Chinese ones. They're the only one that know how to do math, apparently.
So basically, it's mirroring the whole U.S. China, everything.
Chat 5 is still the worst. Gemini is just right above it, and then Grok 4, and then Claude, and the two that are above Bitcoin currently still. Now this ends. When are they going to end this on? Because they give $10,000 for each model, and let's see, they're ending it. I think November. I thought it was like November 5th or something, but they just started it on the 17th. Gosh, I mean, but can you imagine? But $10,000 in and have $3,000.
Oh, dude,
your AI fucking can't actually do what it says. But this is actually an interesting thing about AI. There's been a bunch of articles come out that AI, the companies that are trying their best to get rid of employees and just have AI do things, they're not performing to the level that needs to be. That this idea that AI can do people's jobs is not playing out currently with the technology like it should be.
I did see, although I'll push back on that a little bit. I did see that somebody did a study that shows, like in the last like since Chat 4.0 or Chat maybe 2023. So since 2023, entry level jobs like entry level receptionists, just like the basic level entry level jobs, are down 13% as far as job openings, and they've attributed a lot of that to, oh, we don't need to hire one more person because we got the two people and they can just throw the emails in the chat now. So I thought that was kind of interesting, that because obviously that's the stepping stone for the next generation. You got to start somewhere, and if we get rid of the places to start, that's going to be real problematic. But yeah, it's certainly not replacing professionals right now.
Yeah. So right now
one thing that I was listening to on one of the podcasts that I was I think it was over the weekend, but they were saying that a lot of companies aren't necessarily firing people and replacing them with AI. They're just not hiring new people. Yes. And trying to leverage AI to mitigate the need to have to hire new people. So Taylor, you were saying, sorry.
Correct.
So season 1, today is the last day that they're doing this. So today will be the day that they're going to mark. But I don't know, DeepSeek went stupid on them because DeepSeek was up, almost double what they put in, or more than double, and just tanked ever since then. But this is going to be interesting because they're going to do this again, and I'd like to see once they start again what happens, because we were noting here at the beginning they're all kind of consistent, and then all of a sudden they just diverged. On it appears that.
Well, it's weird because like the first one when they diverged, two of them like just tanked. And then a little bit later on, two more peeled off to the downside. And then, and then you have the two that are still in the positive. But yeah, it seemed like just kind of as it progressed, it's almost, like four of them got worse.
Yes. Yeah. Oh, this is cool. Yeah, they go in here and they show you all the trades that they did.
Oh, that's cool.
So I'm going to go through it and see kind of what DeepSeek versus the other ones is trying to do.
So I saw something else over the week that was trying to interesting. I don't really understand. It's like I'll have to find it, but it's like somebody came up with this methodology that like increases like the total efficiency like 13% for chatbots or LLMs, but it also gets rid of hallucinations for the most part. And so we created two mirror bots, right? It created like we'll call it, one was called like the interviewer, and one was called the interrogator or something like that. I don't know. Like basically, like you had one where you trained it on proper, not Reddit, but like real data. And then so one of the chatbots could see all the data, right? It learns the stuff, and then it asks the second chatbot, which just has access to the open web, questions, and the second chatbot responds based on what it's figuring out, and the first chatbot is correcting and re-prompting. So like it might ask, so chatbot 1 might go, tell me about XYZ. It comes up with some bullshit hallucination about XYZ, and chatbot 2 goes, I think it's this. Chatbot 1 goes, no, it's not this because of these things, reconfigure it. So basically the two run in parallel, and it ended up coming up with like this sort of self-learning loop. Like it's not truly self-evolving, but it's
okay.
Close to anything else they've had. And the idea being when you have one is sort of the control with what they call high protein data, to let the other one create methodologies to figure out how to get to the right answer and figure out what's BS and what's not. It was really fascinating. I mean, dude, guys, we're so close to freaking Skynet. It's so crazy.
And it's only going to speed up.
Yeah, so, it's going to go like
so this. We're running out of time. We only got about 6 minutes left. I know that you guys are on a tight crunch. You're running a business. But real quick, Jeff, what are your final thoughts about the market? Kind of where do you see, where we're at currently, and where do you see the traditional market going from here, and where do you potentially see risk on markets, such as crypto going?
I think the markets right now, the entire story is AI. It's the big seven. So there's a concept called market breadth, and market breadth is a measure of how many stocks are moving up versus how many stocks are moving down. And in a really healthy economy, like this has not ever happened exactly this way, but in a healthy economy, if the market was up 10%, like an intuitive thought would be, oh, the S&P 500 companies in general are worth 10% more because, UPS is making more money and Walmart's making more money and Bank of America is making more money and freaking Chuck E. Cheese. I mean, whatever, right? But when you look at the markets right now, you have these massive companies, right or wrong, especially with all these weird, like, I'll scratch you back, you scratch my back, NVIDIA, Microsoft, OpenAI, Oracle deals that may or may not be real money. People have some questions about that. But those are going gangbusters. And then the rest of the market, like I think I saw last week, like 380 companies or something out of the top 500 companies in America are at 52-week lows, right? They're not doing well. And so that dichotomy, at some point in time, financial gravity comes back together. Either either the Magnificent Seven comes down to earth, or through some miracle, it holds us up long enough for us to go through a recession and come back out the other side and start to come back.
But where would that liquidity come from? It would be my question.
Well, the problem. So I saw a thing this morning that I was reading during my private time, and it said that's anyway.
In the
So
bathroom?
not that private time, the other private time, and it talked about how basically like all of the capital and cash flow coming from these companies is spoken for, like the face, the Metas and the Googles. So any future growth is going to come from debt. And so, like, if you look at Oracle's got like way more debt than the other big companies out there. And so it'll be interesting to see how much debt these companies can take on. Are they willing to take on? Do they want to take on? And is the market willing to let them take on before causing a correction in price? I don't know, man. If I did, I'd have a private jet.
Yeah.
So this AI platform, it's pretty cool because the model will tell you what it's thinking at each given moment.
That's cool.
And so you can go through and like, well, why are you continuing with this? It's like a lot of them are saying, well, I'm holding my ETH position because it's oversold currently. And it's pretty interesting. Like you can go through there and get its thinking on why it's doing what it's doing.
We should drop that URL or something in the newsletter tomorrow.
Yeah, we'll put it in the newsletter tomorrow, and then so people can go on and look at it, because it's very interesting in the way it's thinking and why it did what it did. You can go all the way back to the beginning of the trade, and then it shows you the actual positions that it has.
So Taylor, like you have a foot deeper into both traditional and DeFi markets. Where do you see where we're at currently, and what do you see for the future?
Well, currently we're in this massive bubble where the reality is America is really in a bad spot. I mean, you can't stress, like, we don't really have, I mean, other than AI, we really have nothing great going for us. We're hoping that this turns around. China, I don't care what people say, they're eating our lunch on technology. Like, if things continue, China really is going to be the future, because if they aren't beholden to their large corporations making their profits, and they seem to be, as like, at least kind of in the technology realm, they're more in a position to grow. But the reality is robotics is really the future. AI, it's great. It's wonderful. Hopefully it's going to get past this phase that we're in where it's like the models are growing, they're getting better, but not exponentially like they were. Mm-hmm. But China has all the infrastructure to build all the robotics. If you go online and you watch anything, it's crazy. There's robots walking around in the streets of China all over the place. And we don't even have a company yet that's deployed any. So right. That's really the position, is like, as a nation, we're far behind, and we're not even addressing the issues that we will need to address.
Yeah. Well, I'll give my 2 cents. So I would agree with both of you, obviously. As far as traditional markets, I definitely feel like the Magnificent Seven is a bubble. They're way overinflated. Like Jeff was talking about, the rest of the market has been left behind. I think a lot of people have been trying to ride that gravy train with biscuit wheels and been moving liquidity over to those. And there needs to be a correction. They need to come down, like Jeff said, or the other ones need to come up. And the liquidity is not going to just magically appear. So yeah, I mean, that's what I'll say about that. But as far as DeFi, me personally, the money that I have invested is money I don't need. So I am going to continue to DeFi and earn, because the more that you earn at cheaper prices, when the market goes up, you're just going to be in a better position on those assets. What those assets do, only the future will tell. But me personally, I'm all in. I'm gonna ride it out and see what happens. If we end up going into another bear market, I'll continue to stack and wait, because at some point, I mean, you can go through the news and you can see JP Morgan, like we showed earlier, they're accepting Bitcoin and ETH as collateral on loans. A lot of banks are looking to custody people's crypto. If you look at DeFi and RWAs, real world asset tokenization, everything is being tokenized. I mean, I won't go into the chart. We don't have the time, but it's going parabolic with things being tokenized. You look at DeFi, that is continually growing. And Base here in 2 weeks is about to go fully live with the Base app and give access to the Coinbase's 25 million plus customers, easy access to DeFi on their platform natively. So I see nothing but a bullish future. It's just a matter if you can weather the storm. If you have to take out some profits to feed your family and keep a roof over your head, do it. But do not get it twisted. This is how it's going to play out, and what projects are going to be a part of it can be debated. But crypto, DeFi, RWAs does have a future in finance and in technology. So do with that as you will, but I'm in. So, gentlemen, thank you. And till next time, Veteran Crypto out.
See ya.